to our next segment. So in this segment now, we have already finished talking about the different types of life insurances. So we're going to be moving on to looking at riders and benefits, supplementary benefits. All right, first of all, what's the difference between the two? So riders are things that increase the death benefit, whereas supplementary benefits are things that are adding while the person is still alive. So giving a benefit, they're called living benefits as well. So while the person is still alive. So we'll start with riders and then we'll be switching over and looking at the supplementary benefits as well. All right, so riders, just like I said, they increase the death benefit. So the policyholder is not actually getting anything themselves. It is a beneficiary who is going to be receiving from this. So one of the riders, so I have 4 different ones here: PUA, paid up insurance, term insurance riders, accidental death, and GIB. So 4 different ones. First one is PUA, and we talked about this when we were talking about a dividend option with whole life, paid up additions. So this is when you're using that your lump sum premium to get extra insurance, right? So you're able to add on to your death benefit and get extra insurance without having to pay extra premium. So you're using it as a one lump sum premium to get extra insurance, which is paid up, right? So it would be added on to the death benefit. The next one are term insurance riders. So obviously when you're getting term insurance riders, those are limited time, and riders are things, so these are riders and benefits are things that people can do to customize their products. So if they want to add these things on, it can sort of, it can be tailored towards what they need, right? So some people might want specific riders versus other ones, so it can be tailored towards what they're looking for. Yeah, so term insurance riders, they can get it for a certain time. Now, depending on the insurance company, they might specify it that it's available for 2 years, 5 years. So there is a term that's associated with it, and you would get coverage for that, that term. And with term insurance riders, there's also other riders that can be added, such as child coverage riders. So if someone has children that they would like to insure, but maybe are not able to get policies for each of them separately, they can add them on as child coverage riders. Now that would mean that it wouldn't be the same amount, so it obviously will be a lesser amount than if they were to get their own policy, but it would be something, right? So there would be some coverage. So that's if someone only wants it for children. Maybe they are divorced or don't have a spouse, or their spouse already has coverage somewhere else, they don't need it. So they're only looking specifically for children. If they're looking for children and their spouse, then they can use the family coverage rider. So same thing, one person would have the original policy, and then this rider can be added on to insure the children plus the spouse. Now keep in mind that riders are only in effect as long as the main policy is in effect. These are add-ons. So you cannot have add-ons that can stand on their own. If the main policy is canceled, the riders are also gone, right? So they are attached to that main policy. The next rider that can be added is called accidental death. So this is when someone passes away because of an accident, and that part that says accident is important. If it's ruled out afterwards that it wasn't an accident, let's say a person actually passed away because of a heart attack or something else while driving, then this rider won't apply, right? So it is specific to the fact that it has to be because of an accident. And there is that limitation of 365 days, so a year. They have to pass away within the year. If they're in a coma or if they're in the hospital, and then that deadline passes, so this rider will not be applicable, right? And what this rider does is that it gives the double indemnity. That means that whatever the face amount is, it will give the double of that. So if the face amount is 500,000, the person beneficiary will receive $1 million. All right. And another thing to keep in mind is that this rider may terminate at a specific age. So again, depending on the policy and insurance company, they might say that this rider falls off at age 50, 55. So it might not be something that is continuing for the life of the policy. And the last rider we're going to talk about here is guaranteed insurability rider, GIB. And if you remember, we talked about a similar rider in our second module with accident and sickness. So this is a rider that allows you to purchase more life insurance in the future without the proof of insurability. So again, for someone who maybe can't afford higher coverage or doesn't really need higher coverage right now, but they know in the future they will get married, have kids, have a home. So they know their needs are going to be growing. So they want to have the option to get more in the future, but don't want to worry about insurability in case if their health is not that great, they don't want to be turned down. So they can add this rider. So that way the insurance company cannot turn them down or ask them for any sort of proof of insurability. However, the premium will be based on the new age. So whenever this rider is exercised, whatever the person's age is at that point, that's what the premium will be based on, right? So these are the riders. We're going to switch over now to the benefits as well. So let's switch over. We can take a look at that. All right. So now we're just shifting over to the second half of this segment where we're looking at the supplementary benefits. So like I said, riders are things that increase the death benefit, so they go to the beneficiary, whereas supplementary benefits are considered to be living benefits. So they're helping the policyholder while they're still alive. So there's a few different ones that we'll look at today. The first one is dread disease, also known as GD, or also known as CI, which stands for critical illness. And just like when we looked at accident and sickness, there's a list of things that are covered. So there are specific conditions. There is that big four that applies again here, that all insurance companies in Canada have to cover as a law, but insurance companies usually cover a lot more. So they usually have a list of the conditions that they cover and are classified under this. So if anyone has any of those conditions, they can get a lump sum tax-free benefit. Now, this is from their original death benefit. So let's say if the death benefit is 500,000, insurance company might give half of that while the person is still living, so they can use that however they want. If they want to go on a vacation or take care of some bills, whatever they want to do, and then the rest of that, the remaining benefit, will be paid to the beneficiary. So it's not an addition, it's from the original benefit. They're giving some to the person while they're still living, and then the rest will be given to the beneficiary. All right. The next supplementary benefit that we're looking at is accidental dismemberment. So just like accidental death was the rider, accidental dismemberment is the benefit that can be added on. So again, because of an accident, somebody loses a body part or the function of a body part. So if a payment can be made if somebody loses like an arm or a leg because of an accident, so they are able to have a payment because of that. And they may even again pay half of the death benefit here. So give half to the person while they're living, and then half can be given to the beneficiary when that person passes away, right? So it's coming from the same pool, the death benefit, but it's just a way to help the person while they're still alive. So that can be used as well. The next one is a waiver of premium for total disability. Now, this is if somebody's totally disabled, and we talked about what total disability is in our previous module with accident and sickness, so I won't go over all of that again here. But if somebody's totally disabled, then and they have this benefit added on, then their premiums will be waived off for the rest of the policy, but the policy will still be in force, right? So that's another way that they don't have to worry about premiums or their policy lapsing. Maybe they're not earning the same sort of income and can't afford it anymore. So this is a rider that can be added on as well. So the premiums will be waived if that person is considered totally disabled. And then last one that we're looking at here is parent and payer waiver benefit. So similar to this one. So let's say if the person who has a life insurance is a minor and the parent is paying for them, or there's another person paying for them, or they're not able to pay for themselves, whatever the case is, that there's a separate payer for the actual policy. So now instead of having the waiver for the original person, we need a waiver for the payer, the person who's actually making the payments. So this is where this benefit comes into place, that if the person who's actually paying the premiums, if they could become disabled or something happens to them, then the premiums will be waived, right? So that it can be added on as well. So these are the different types of benefits that can be added on. And like you can see that these are all things that are helping the person while they're still alive. And that way, usually it is taken from the death benefit, but it's a way to sort of help out while the person is still there. All right, perfect. So those are riders and benefits. And of course, We know that riders have many advantages and riders and benefits have many advantages. We did talk about them when we looked at accident and sickness as well. So it allows a person to customize their coverage based on their own needs. If somebody's looking for, let's say, critical illness, or if someone's looking specifically for that waiver or parent waiver benefit, so they can add on whatever they feel is needed. So that is something that is great as well. And of course, one of the biggest disadvantages is that they don't stand alone, right? So you have to have the original policy going in order for these riders and benefits to continue as well. All right, perfect. So thank you so much. Join in our next segment. So now we'll be looking at group life insurance, just like we did with group accident and sickness. We'll look at how employers have different plans for group life insurance and how they work. All right, thank you so much. We'll see you in the next segment.